Well, welcome back to another conversation around this crossing the threshold piece that we just recently released here at Chi Association. As usual, I'm excited to have one of the authors and contributors to this piece with me today. We're going to talk through some of the concepts that they covered as part of their contributions to the overall piece. So I'm joined today by Shannon Saccocia, who's the Chief Investment Officer of MB Private Wealth, and the last contributor of the piece, who kind of closes out our journey. So excited to get into things. And Shannon, thanks so much for joining me.
Thanks so much for having me, Aaron.
So Shannon, I thought, as we kind of laid this piece out and we're talking about the concept of a journey to integrating alts into a portfolio, I thought it might make sense just to start with you as an investment professional and the fact that you started in the long only space and made that transition into alts relatively early in alts life cycle. Would love for you to just talk about your journey, some things that you learned as an investment professional.
Sure, I'd love to. And it has been quite the journey, and I think it's one of those journeys that will likely continue, and so one that you can learn a little bit more every single year. But to your point, I started in the wealth management industry back in 2006, and had come from more of a institutional consultant track. And entering into a very small registered investment advisor, sub $1 billion in 2006, as you can imagine, most of that exposure, if you will, was in the long only space. We did have, I would say, some very limited exposure to privates, but it tended to be investments that our clients had been introduced to outside of their relationship with us. And as you recall, in 2006, 2007, there was just starting to be a real push to move investments from the institutional world into that, sort of multifamily office space or RIA space, especially for larger clients in the RIA space. But there wasn't a lot of activity. And I think so, even for those of us who in those first couple of years, 2006, 2007, any progress that we really made in looking at alternatives as a part of an overall allocation sort of ground to a halt in late 2008 and early 2009. But what was really interesting is what did work during that period. And I think a big part of my transition in moving from really focusing primarily on long only equity strategies was looking at some of the strategies that were able to withstand the GFC, those strategies that did actually have either an edge, if you will, from an intellectual perspective or a process perspective, and those that were just either non-correlated or very loosely correlated to what was happening in the market. And that was really a thrust, if you will, or an impulse following the GFC that there is life outside of the long only equity space in particular, but even in the fixed income space. And I think the challenge there was sort of finding those opportunities. Usually, especially if you were in a smaller registered investment advisor around that time, that those great opportunities weren't necessarily trickling down, and so you did have to go out and really look for them and tap institutional colleagues, tap those access points that we had thought about being available during those periods. They weren't as readily available as they are today, but they really did create a foundation for some of my learnings and my transition into the alternative space.
That's great. And Shannon, you've been CIO at three different organizations now, so have probably gone through a couple of journeys within the organization more broadly, just outside of yourself as an investment professional. Could you just talk a little bit about maybe how the different organizations that you've been at have approached alternatives from a broader organizational perspective, and maybe some bumps along the way, things that you learned, success stories that you found as you started to integrate both maybe the hedge fund but also private markets space into client portfolios?
Sure. I would say initially, in the organizations such as Boston Private, our inclusion and our work on alternatives was, in part proactive, but in many cases reactive. We were managing large family assets. We were hearing from particularly next gen clients about the things that they were hearing about in their professional networks and their personal networks. And so realizing that, we needed to be looking around the corner for opportunities rather than looking at what we were doing or the firms next to us were doing in order to make sure that we remained very much relevant for this next gen of clients. And so I think at Boston Private, a lot of those clients had never invested in alternatives. They were very hesitant about illiquidity, and they really they looked at liquidity as safety, and in many cases that takes some time to overcome that particular hurdle. When we moved on to SVB, as you can imagine, just given the different client base there, the amount of founders for whom we were managing their wealth, their familiarity with not only early stage venture, but all the way to angel investing in terms of being at the genesis of some of these companies' experiences. It was more about what how you could build a programmatic approach to alternatives. And so, whereas, with a certain type of client base for whom their environment has created wealth for them really outside of, the public markets, this community was in many cases catalyzed to their wealth through the public markets. But earlier on in the journey is where they really monetized that opportunity. And so now, at NB Private Wealth, we have a little bit of a combination of all of those things. We have generational wealth that we're managing for. We certainly have a number of business owners and entrepreneurs, but we also have this really important next gen contingent for whom we understand there are so many opportunities in the investment universe for these clients, and they're really looking for us to curate, synthesize, and deliver what makes the most sense for them. And I think that's where you have to really widen your aperture and look across public and private, because our clients are sophisticated enough that they're hearing about those opportunities, whether we're talking to them about them or not.
Yeah, I think that's a good point, and I love kind of the difference of coming from public to private, and then almost private to public, and the diversification story rings true regardless of where you're at in the life cycle. And that brings me to in your piece, you talk a lot about setting expectations with clients, alts, and you can that's a broad term, but a lot of alternatives belong at the core of the overall portfolio. And I think that rings true regardless of which type of client profile you're talking about. Could you talk about, as you were setting expectations with clients, whether it is that long only client that's moving into alts, or the private market, founder, entrepreneur that's you're trying to diversify outside of maybe aggressive early stage venture? How do you set expectations with some of those clients, and what have you found has actually resonated and gone over well with some of those clients as you set those expectations?
Well, there certainly have been some hurdles, as all of us are very well aware. There have been several years that were buoyed by very low, if not zero, interest rates that created a lot of opportunities, particularly in the public equity market. And so, when you're achieving really what could be described as somewhat persistent outsized returns, when you look at a 10-year period back through, say, 2010 or so, and you think about kind of 2010 2020, and then obviously with what we experienced in 2023, just the rationale for, as a comparison to what you could potentially achieve in private markets versus what you're experiencing in public markets, that delta is sometimes hard to justify. I also think that there's I think there's a challenge for wealth management professionals, and that we're always looking to try to simplify our clients' lives. And alternatives, in their nature, they appear to be more complex. And so the way that we overcome those objections is we really highlight for our clients understanding, the depth and breadth of the investment universe, and that if you think about an iceberg, for instance, how much of that is underneath the water, that's really what you see in the private markets. There's so much. And if you look at an asset class like small cap, for instance, and you look at the decline in the number of publicly listed small cap companies, well, there's still plenty of companies out there. They're just not public, right? And so trying to highlight with metrics, you don't want to use the fear factor. You don't want to talk to clients about what they're missing out on if they don't get into this particular deal. You really want to talk to them about, in order to be able to create that desired outcome, you want to be able to tap all of the different areas of potential return and be able to balance out the risk in certain areas. And so I think that's the analogy, if you will, that we found to be successful with talking about clients, is just really factual, setting the stage for them, talking about the changes in market dynamics, talking about the opportunities that are available outside of the public markets, not scaring them that they're missing out on those, but really just saying, if we're looking to develop for you a diversified multi-asset portfolio that can deliver your outcomes, public and private should be in both in that conversation along that frontier.
Yeah, I love that point. And look at stats. I mean, there's a lot out there around just on the equity side. 87 to 90% of companies are private in the states, at least, and so there's a whole opportunity set. Whether you invest or not, you should at least consider it. And you think about that on the debt side too.
And if I could just add on the fixed income side, a lot of what's happened from a financing perspective, from a credit perspective, historically was sitting within banks. And a lot of those business lines, particularly those tertiary business lines that, were difficult to scale or were more esoteric, those have really been, I would say, abandoned in many cases by typical financiers. And so you look at that liquidity need on the credit side, and so that's much harder to track because there aren't these kind of big broad indices that show this quantitative decline. But I think it's important, if you just look through to bank balance sheets and you think about the lines of business and you think about the areas in which they have concentrated their loan growth, that's not because those opportunities to lend aren't out there. It's because they require that additional level of work, or potentially taking on a level of risk that those banks are not as comfortable today underwriting as they maybe were 10 years ago.
Yeah, exactly. Just because the supply went away doesn't mean the demand is
Correct.
gone. Yeah, exactly. So Shannon, maybe a question on the practical side. So if there's a newcomer who is new to alts, they want to cross that threshold, to use the title of the piece, and really start to think strategically about integrating alts into their clients' portfolios. What advice do you have for them in terms of starting? Where should they start? Any tools that you would recommend to get them on that first part of the journey?
First and foremost, just understand the structures and the strategies that are out there in your seat as an advisor. There's so many opportunities for education that are available, whether it's through Kaya or other means, throughout the arsenal that we have. There's so many ways that you can become educated and confident on those areas. And then really think about what what is your client's time horizon? What is their life cycle? The worst thing that you can do is go to a client who hasn't had any alternatives experience and is uncomfortable or potentially uncomfortable with illiquidity, and offer them something with a 12-year term and four more extensions, and they're looking at a 15, 16-year experience to understand whether that worked. So I think if you're looking at, particularly from a private client perspective, but really even with institutions perhaps that haven't had alternatives or private markets exposure, thinking about, okay, are there strategies in which you start to see some distribution of capital a little bit earlier? Because that's the metric, that return metric, like how am I doing? How am I experiencing this investment? That can keep them in their seats. It can also support, moving from a core positioning to a more programmatic approach over time. So I think with core, if you think about private equity, there's a lot of core private equity strategies, and you can go with a fund of funds, for instance, and that provides you some diversification. Secondaries are a great opportunity for investors who are looking for a little bit of that shorter J curve, that payback to come a little bit faster, to have those distributions potentially offset some of their capital calls. And then looking out on the debt side, thinking about it in terms of maybe something shorter duration, because again, you start to see the results of your investment. That gives you some confidence that although you can't look it up on your phone every day and look at the price and how it's doing, it does give you that confidence that there's a strategy there. And then the final thing is really to set appropriate client expectations, but also to keep them updated. In many cases, there's limited liquidity or no liquidity for these investments. So I think sometimes advisors are sort of adopt a set it and forget it approach in terms of, well, there's nothing really to report. There's, we'll get numbers at the end of the quarter, or things are on a quarter or 6 month lag. And so that's actually very counter productive in terms of trying to build that foundation over time. You should move from, okay, we've set the stage, we've given you the expectations. Now we're starting to see capital being called. Why is it being called? What's the opportunity set? And then as distribution starts to occur, talk about what worked, what didn't work, how, really dig into that performance with the client. They might not be looking to, they might not be able to make an explicit decision on getting out of that investment at that time, but it just gives them that greater comfort. And it also sets the stage again for that vintage year diversification, for that continuation over time. And then the final thing is evergreen vehicles. There are more evergreen vehicles available. And for some clients who don't want to have to make that sort of re-up decision every couple of years, those offer, they generally have some liquidity. Even if it's limited from a tender perspective, but they also are, in the market on a month by month, year by year basis. And so your client can put an initial position in, then they can potentially add to it. So it just gives a lot of flexibility in terms of getting people into a position, feeling really comfortable about it. But there is a huge onus on the advisor to continue those conversations and make sure the client still understands 2, 3, 4 years from now why they made that initial allocation, how it's doing, and that what's sort of the next thing on the horizon that they should be thinking about.
Yeah, I love that, and what you've described as a journey, Shannon. So that works really well with all of this, and I like the idea of easing into it. And it's no longer really binary at this point. It's not fully liquid mutual fund and then just go over to a drawdown fund. There's so many options in between to kind of dip your toe in the water, if you will. So Shannon, before we sign off, any final thoughts or words you want to share with the audience?
Well, I personally am pleased that we have so much discussion around private markets in our industry today. I think from a wealth management perspective, it's been really nice for me to see the increased engagement at the advisor level, the increased engagement at the client level. But, with that, there comes some questions around, the sustainability of the returns. Is there too much capital? We've had some really interesting and perhaps anomalous exit years in the last 4 years, where we went from a lot of exits to very few exits. And so I think that there are some concerns. And so, my guidance and our view is that private markets should be, for the longer term, a part of your portfolio, and that this additional transparency, this additional level of dialogue and discussion is actually great for the industry, and it's great for individual client outcomes, because the more educated that we all are, the better that we can assess these investment opportunities and determine what's suitable in terms of getting to that long-term outcome. Not everything is suitable for every client, but with this enhanced education, discussion, dialogue, I think that we'll all be in a better place 5 years from now, and certainly 10 or 15 years from now, when those lines between private and public are going to be much more blurred, if non-existent.
Well, I can't take the other side of that. Well, Shannon, thanks so much for your thoughts, and thank you for your contributions to this piece. I'm excited for people to read it and to see it.
Thank you so much, Aaron.